So let's first get into, what is a 529? A 529 is essentially a tax advantage savings account earmarked for mostly college education expenses, although you'll see they've kind of opened it up to other educational expenses besides college. So what it does is a participant will open an account for a beneficiary. So in most cases, a parent will open the account for the benefit of their child, right? So I have one, I opened it for my son. I'm the owner of the account, which is important, and he is the beneficiary. The owner controls the account, controls the investments in the account, but anyone can put money into it. And why that's important is we all know kids may get checks from aunts, grandparents, cousins. Those payments can go into a 529 as well. So anyone can add money to it, and it's for the beneficiary for the child's college education expenses. That money is invested. A lot of times these 529s will have target dated funds. So much like a retirement account may target when you're 65, a college account may target when you're 18, because that's most likely when the funds will be utilized. So you can invest this money according to the age of the child, let it grow. And one of the huge tax advantages is that when the money is withdrawn for a qualified expense, it is not taxable to the beneficiary, to the student.
But let's go back to the contributions now too. So, okay, so if it grows tax-free, it's almost like, let's walk through the mechanics of it too. So you talk about how you opened one up and that was for Jack, right?
That was for Jack, my son Jack.
Nice. All right. So we're not planning on a big soccer scholarship. Yeah. Is there anything in the plan? Okay.
But let's plan for the worst.
Right. Yeah. You never know. It's a tough gig out there. All right. So whether it's you as the owner or aunt, uncle, grandparents, etc., is the owner able to write off anything that goes in? Are there income limits, or just let's talk about money going in the first place?
Great question. So it's kind of almost like a Roth IRA in that the contributions that you or any family members make is not tax deductible. Okay, so you cannot offset that. The tax advantages for a 529 are that the funds grow what we call tax deferred. So if you buy, fund X for $1,000 and it's worth, $3,000 the next year, there are no taxes owed, okay? And then most importantly, when the funds are withdrawn, so when they're taken out, again, usually at 18, 19, although it doesn't have to be, all the gains, just like a Roth IRA, are tax-free if they're used for what they call a qualified expense. Now, I will make a note that some states offer small state tax benefits if you use the state-specific plan. Now, every state has a plan that they incorporate with a provider. In Massachusetts happens to be Fidelity, and you get a very small, and I say very small, a state tax deduction if you use the Fidelity plan. And some of the common misconceptions is that, well, if I open up a Massachusetts plan, my child has to go to school in Massachusetts. That's not true. They can go to any college, any third level education, but there is a small state tax incentive. But that's really the only tax deduction you get now. Again, Matt, kind of like a Roth IRA, the funds grow tax deferred. They're taken out tax free later on.